Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Fair Isaac, or FICO.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, it really does help us out.
And before we jump into the absolute roller coaster that FICO is on right now, just a quick heads up. For our framework today, we're using StockOracle.
Right, which is this really great AI-aided stock research platform we use to help prep the show. And we actually have a special 14-day trial link for it down below in the description.
Exactly. Just remember that it is an affiliate link, so we might earn a commission at no extra cost to you. And, just to be super clear, StockOracle is a research tool, right? It's not financial advice.
Definitely not. No trading signals, no real-time market data. You always have to verify facts yourself because, AI insights and valuation estimates, they can sometimes be incomplete or just wrong.
Yeah, nobody has a crystal ball. But okay, let's get into the hook for today. Fair Isaac. We all know the three-digit number, right?
Oh, for sure. You get your credit card statement, you see a 720 or an 800, and you feel pretty good about yourself.
Right. It is basically the ultimate standard of predictability in the American economy. But right now, the company itself is going through this massive identity crisis. Wall Street is finding it completely impossible to score FICO itself.
It's honestly a stunning reversal. You have this company that basically dictates the mechanics of lending, and the market has absolutely no idea how to price its stock.
Yeah.
The contrast between the rigid numbers they sell to consumers and the wild volatility of their own valuation, it's something you rarely see in a blue chip stock.
Exactly. So we need to figure out how a multi-billion-dollar monopoly suddenly starts showing cracks. And to do that, we're going to follow our standard framework. So starting with the wealth-building context and the fundamentals.
Right.
Because before we even address why the stock is crashing, we have to talk about how they actually make their money. And, looking at fiscal 2025 revenue of $1.99 billion, they definitely know how to make money.
Oh, they are a cash-generating machine. Like, if you look at their most recent quarter, Q3 of fiscal 2026, they brought in $674.2 million. So that's a 26% jump year over year.
Wow.
Yeah. But, to really understand what's happening, you kind of have to split the company in half. FICO isn't just one business, it's two segments, basically sharing a ticker symbol.
Okay, so software and scores.
Exactly.
Well, let's start with software. Because
Okay.
looking at the numbers, I'm seeing this weird contradiction. Their legacy software revenue, like the old non-platform stuff, is plunging. I think it dropped 17% year over year in Q3.
Yeah, down 17%.
But then management is claiming this massive victory in software. How does a huge drop translate to a win?
Right, sounds totally backwards. But that decline is actually intentional, even if it looks messy on paper. They are basically cannibalizing their own legacy business to force a transition to a modern cloud-based software-as-a-service platform.
Ah, okay. So they're just pushing clients off the old clunky installed software and forcing them onto a subscription cloud thing.
Correct. And the adoption rate for that new platform is super aggressive. The annual recurring revenue, the ARR for the new platform, climbed 49% to $349 million.
Wow, 49%.
Yeah. But the metric that truly matters here, the one you really want to pay attention to, is their dollar-based net retention rate. It hit 136%.
All right, just to anchor that for everyone listening, 136% net retention rate means that if you look at a group of banks who subscribed last year,
Yeah,
they aren't just renewing, they're actually spending 36% more this year.
exactly. They're buying more modules, they're adding more users, just expanding their footprint. It's a textbook land and expand strategy. Once a bank integrates FICO's cloud architecture into their daily loan approval workflows, it becomes incredibly painful to rip it out.
Right, it basically becomes the central nervous system of the bank.
Exactly. So while the overall software segment only grew like 2% in Q3 because of the legacy products dying off, the underlying foundation of that new platform is remarkably sticky.
I see. So the software side is this slow, steady build. But let's get to the real profit engine, the side everyone actually knows, the scores segment.
The crown jewel.
Right. Because in Q3 alone, revenue for scores was up 41% to almost $459 million. In Q2, it was up 60%. And almost all of this explosion is tethered to U.S. mortgage origination.
Yeah, they've held a virtual undisputed monopoly on the credit scores used to underwrite mortgages here in the U.S.
But wait, this is where the math totally breaks down for me. You just said mortgage origination revenue is up 41%, but mortgage rates have been super high, and anyone looking at the housing market knows volume is incredibly soft right now.
Oh yeah, volume is way down.
Right, fewer people are applying for mortgages, so if the volume of traffic is slowing down, how on earth is FICO making 41% more money?
Pricing power. Yeah. Just pure, unadulterated monopoly pricing power. When volume drops, a normal company suffers. Right. But when FICO saw mortgage volumes drop, they just hiked the fee they charge lenders for pulling a credit score. They just squeezed more juice out of a shrinking lemon.
That is wild. Let's think about that mechanism for a second, because people call FICO a toll booth, but I don't think that's quite right.
What do you mean?
Well, they're more like a universal language. If a local lender originates your mortgage, they rarely keep it on their books. They package it and sell it to Wall Street or to, government-sponsored entities like Fannie Mae and Freddie Mac.
Right, the GSEs.
Yeah, and Wall Street won't buy a bundle of mortgages if every local bank is speaking a different dialect of risk. They need a standardized dictionary to know exactly how risky those loans are. And for decades, FICO has been the only recognized dictionary.
That is a much more accurate way to look at it, actually. Because Fannie and Freddie literally wrote into their rules that a loan must have a classic FICO score to be purchased. That regulatory requirement is what built the monopoly. Local lenders had absolutely no choice but to pay FICO whatever they demanded.
Right, because without that specific score, the mortgage was literally unsellable. Okay, so moving through our framework, let's talk about the catalysts, because clearly this company has some incredible structural advantages. What is driving the stock forward from here?
Well, the biggest catalyst is their direct licensing program.
Which honestly sounds like a very dry, bureaucratic initiative.
I know it does, but it is the absolute lifeblood of their new strategy. It's basically the operational plumbing they need to roll out their new pricing structure. But there's a massive roadblock. According to the CEO, Will Lansing, the internal mechanisms are ready, but FICO is literally waiting on certification from a GSE to flip the switch.
Wait, literally waiting?
Yeah, that's a direct quote. Fannie Mae or Freddie Mac has to officially certify the program before it can launch. And there is no clear timeline.
Oh, that has to be agonizing for investors.
Beyond agonizing. Every single quarter this gets delayed, revenue gets deferred. But worse than that, it creates a vacuum of information. Investors are starting to wonder, is the government intentionally stalling to let competitors catch up? Are there technical issues? It just breeds uncertainty.
Yeah, the market hates uncertainty. Aside from that, what else is coming up?
The other major catalyst is their upcoming Q4 fiscal 2026 earnings, which should drop late October or early November. That's going to be the ultimate stress test for that software division we talked about. Wall Street is going to be watching intensely to see if that software growth can carry the weight, while the core scoring business is stuck in regulatory limbo.
Which perfectly transitions us to the technicals. Because despite all these great fundamental revenue numbers, the stock chart looks like a horror movie right now.
It's an absolute bloodbath. FICO is currently trading around $1,045.
And what was the high?
The 52-week high was $1,998, which it hit back in October 2025. So it is down nearly 48%.
Nearly half of a blue chip monopoly's value just completely wiped out.
Exactly. But here's the craziest part about the technicals. Even after losing almost half its market cap, FICO's price-to-earnings ratio, its PE, is still hovering around 31.9.
Okay, so for anyone listening who doesn't spend their days staring at stock charts, what does a PE of 32 actually mean when the stock is already down that much?
Well, it comes down to this concept called multiple compression. Think about it like buying real estate in a neighborhood that is guaranteed to gentrify. If you know property values are going to skyrocket, you're willing to pay a massive premium today for a house.
Right.
That premium is your PE ratio. Investors were perfectly happy paying 32 times FICO's current earnings because FICO was a guaranteed government-mandated monopoly. They were literally pricing in perfection.
Ah, they assumed FICO could just keep hiking prices forever with zero consequences.
Exactly. But multiple compression happens when that underlying narrative breaks. The house didn't burn down. FICO is still highly profitable, but a landfill just opened up next door. The guarantee of perfection is gone. So investors suddenly refuse to pay that premium. They demand a discount.
I see. So FICO's actual earnings could stay completely flat, but the stock price plummets simply because the psychology of the market changed. The multiple compresses because the monopoly premium evaporated.
Exactly. When you are priced for perfection, there is no margin of safety.
And that leads right into the sentiment. How is Wall Street reacting to all this day to day?
The reaction has been violent. Just recently, the stock cratered nearly 7% in a single trading session,
Wow.
just because Wolf Research downgraded them to peer perform.
Wow, 7% on a downgrade. And wasn't the broader market actually up that day?
Yeah. The Nasdaq was rallying on geopolitical news. So this wasn't macroeconomic weakness dragging down the tech sector. This was investors explicitly hitting the eject button on FICO.
Okay, so we have an incredible business fundamentally, but a broken chart and terrible sentiment. We need to answer the why. And that brings us to the most critical part of the analysis, the risks and the bear case. Why did that monopoly premium evaporate in the first place?
The regulatory earthquake.
Right, April 2026.
Yeah. For years, the CEO brushed off their main competitor, VantageScore, saying they only had like a 2% market share. But then in April, the Federal Housing Finance Agency, the FHFA, made a monumental announcement. They declared that lenders can now use VantageScore 4.0 alongside the new FICO 10T model as eligible scoring metrics for mortgages.
So the government just officially endorsed a second dictionary. They told lenders you no longer have to exclusively speak FICO.
Exactly. It introduces formalized, government-approved competition into a space where FICO hasn't had to sweat for decades.
And the way FICO reacted to this is so fascinating to me because right as this FHFA announcement drops, FICO drastically changes how they charge for their new 10T score. Historically, they charged about $4.95 up front every time a lender pulled a score right. But suddenly, they slashed that upfront price all the way down to 99 cents.
A massive frontline discount.
Yeah.
But, and this is the kicker, they tacked on a completely new mechanism, a $65 success fee that the lender only pays on the back end if and when the mortgage actually closes.
Okay, think about that. Like the last time you bought a house, you probably had 3 different lenders pull your credit before you even chose one.
Oh, easily, yeah.
Under the old system, lenders ate that $5 cost every single time for millions of dead-end applications. It burned cash. So FICO comes in and says, we'll drop your upfront cost to 99 cents, but if you actually close the loan and make money, we want a $65 cut. My question is this a genius strategy to capture massive back-end value? Or is this a panicked capitulation because their terrified lenders are going to switch to VantageScore?
And that exact debate is what is tearing the valuation apart. Right. Management, of course, spins this as brilliant leverage. They think they can capture huge market share with the 99-cent hook and make a fortune on the $65 back end.
But $65 is a huge jump from $5.
It is. And Wall Street saw it as capitulation. You just don't slash your frontline pricing by 80% if your moat is impenetrable. You do that when you are flinching.
Add to that, there's a March 2026 Senate letter that specifically called out FICO's past price increases as a potential antitrust concern. And, just to be super clear, we aren't political analysts. We're not taking a stance on whether that letter is valid or not.
Right, absolutely. We're just looking at how the market interprets it.
Exactly. And strictly from an equity research perspective, when politicians start throwing around the word antitrust regarding your pricing power, your regulatory moat is officially under siege.
The moat isn't just breached. It's being actively investigated. You have regulatory agencies forcing competition on one side and politicians scrutinizing your historical pricing on the other. It's the perfect storm for a bear case.
So bringing all this together for the final verdict, we've gone through the fundamentals, catalysts, technicals, sentiment, and the massive risks. Where does this leave FICO?
Well, looking at the consensus, the rating right now sits at a 5, which translates to exactly neutral.
Which feels appropriate. I mean, they are fundamentally sound, they print cash, but they are structurally challenged.
Neutral is really the only defensible position given the data. To move to a bullish outlook on this stock, investors really need hard proof. They need concrete confirmation that the direct licensing program is finally certified and operating.
Right.
And more importantly, they need numerical proof in these upcoming earnings reports that VantageScore is failing to steal market share. Like, if VantageScore remains just a 2% nuisance, then this 48% sell-off was a huge overreaction and there's massive upside.
But on the downside, if VantageScore starts eating, 10, 15, 20% of the market because lenders like the alternative,
then the monopoly is truly dead. And that multiple compression we talked about will just continue to drag the stock down. Until we see the actual market share data under the new rules, everyone is just guessing.
And this highlights an incredible warning from the StockOracle platform we use today. No matter how good the AI models are, the future is inherently uncertain. Nobody, not the analysts, not the CEO of FICO, and definitely not an algorithm, knows when or if that certification will happen. It's a known unknown.
Which is why you always have to verify facts and make your own decisions.
Exactly. So to wrap this up, I want to leave you with a final thought to chew on. FICO built a multi-billion-dollar empire over decades by doing one specific thing. They categorized the messy, complicated financial lives of everyday consumers into exact, reliable, predictable metrics. They are the ultimate definers of risk.
Yeah, they engineered certainty out of chaos.
Exactly. Yet today, because of sudden government intervention and these delayed rollouts, Wall Street is finding it completely impossible to accurately score the risk of FICO itself.
It's so ironic. The machine that grades the entire economy is currently sitting with a giant question mark on its own report card.
It really forces you to rethink how permanent any competitive advantage really is.
It really does.
Well, thank you for joining us on this breakdown. Remember to check out the description for that special 14-day trial link for StockOracle so you can explore these catalysts yourself.
Yep. Keep questioning the data. Always look for the structural shifts behind the headlines. And we'll see you next time.
See you next time on Smart Wealth with Joshua.